Welcome to the Am I Rich Yet podcast, a weekly podcast for millennials and Gen Zs where we teach you how to spend, save, and grow your money smarter. Welcome to episode 9, where we are talking about all things investing. This is part 1 of a part 5 series. My name is Georgia. I'm one of your co-hosts. I'm a Gen Z current MBA student studying in Sydney, Australia, and navigating my own personal finances.
I'm Rob, Georgia's dad, recently retired financial advisor, and I'm here to help you make smart decisions with your money. So George, what are we doing today?
We are talking about investing.
So today we're going to cover the basics, and we've got a lot of them. And I think, an interesting story. When I was really young, I went to the Toronto French School, which meant I was pretty good at French, wasn't so good at English. And so I missed all the basics of English. And so I was always terrible at writing. Investing's the same way. This is the basics of investing. If you miss this, you'll probably not be very good at investing. So you need to pay attention today. There's a lot of detail. We're going to cover all the different types of investments, advantages and disadvantages of each.
I love it. Now, before we jump right into it, I'm going to ask you a question, and you're not expecting this question, but I want to know, and I want our audience to know, what is your single most expensive purchase you've ever made, not excluding a car or a house? I know I've thrown you off, so take a second to think about it.
Wow. Most expensive purchase I ever made was probably one of our family trips.
Okay.
So we've been doing family trips, a lot of them over the Christmas holidays, and they are very expensive, especially as the families continued to expand. At one point, we needed 4 bedrooms.
Okay.
Luckily, we're back to 3.
Do you have a question to throw me off guard for this episode?
What is that? A tennis dress or a sundress?
Yeah, I showed up today and my dad was like, "You look like you just got off the tennis court." And I said, "This is called resort wear. This is post-swim, ready to walk on the beach, on the dock for an Aperol spritz. I'm ready for anything. And if I get invited to a tennis match, I can jump in and play as well."
Okay. You realize you're enjoying all this freedom is about to end in 10 days and you're back to school, eh? Okay. Let's get started. The 6 most common types of investments we're going to cover today are cash and GICs. That's 1. Number 2 is bonds. Number 3 is stocks. Number 4 is mutual funds. Number 5 is ETFs or exchange traded funds. And number 6 is real estate. So let's get started with cash and GICs. This is at the bottom of the totem pole. Okay. Very low risk. So is when you give your money to a bank, to someone, and they're going to give you an interest return. So you give them $10,000 and they're going to give you 3% today. Tomorrow it may be 3.2%. So the problem with cash is the rate of return tends to fluctuate every day, especially if interest rates are fluctuating a lot. If interest rates are the same, you're going to get the same return. A GIC is a little different because you're tying your money up.
What does it stand for?
Guaranteed investment certificate.
A guaranteed investment certificate.
So you're guaranteed to, if you buy a GIC, a 3-year GIC, and it's paying 3%, you're guaranteed to get 3% a year for the next 3 years.
Got it. So quickly, high level, the differences between cash, GIC.
Okay. Biggest difference is typically liquidity. Cash is completely liquid. You can cash it in tomorrow and get your money. GIC, you may have locked it up for a longer period of time.
Right.
Now, there are cashable GICs, but you're going to get a lower rate of interest because it's cashable. The more features and benefits you add, the less you're going to get back. What I like about advantages of cash GICs, number 1, your capital is protected. In this country, you've got $100,000 CDIC insurance in the event of fraud, bankruptcy, for cash accounts and GICs. So that's pretty good. A couple would have 100,000 and 100,000, so they could have 200,000. So very safe, very secure. Predictable returns. You know what you're going to get. So another advantage, pretty easy to understand. I give you $100,000, you're going to pay me 3% a year for the next 3 years, 5 years. Okay? What are the disadvantages? Lower returns. Don't like that. Never like lower returns. limited access if you've locked it in. If your emergency fund is in a 3-year GIC, you can't get to your emergency fund in an emergency, okay? And finally, there's no compound interest.
Warren Buffett.
When Warren
Albert
Buffett
Einstein.
said, it's the 8th wonder of the world. So you don't want to miss out on the 8th wonder in the world when you're investing, okay? Next, let's cover bonds. Bonds are very similar. They're a fixed type of investment. The difference is you're giving the money to either the government of Canada, government of another country, a province, or a corporation, a company. They're going to give you as well a fixed return. It could be 1 year, 5 years, 10 years, 20 years, 30 years.
So the main difference between a cash/GIC and a bond is a cash and GIC you're giving to the bank versus a bond you're giving to government or corporation. Typically,
that's the biggest difference without getting too complicated. Because everything, there's 20 different variations of everything today. It's like when you go shopping for, mayonnaise, there's 20 different flavors. There used to be 2 flavors.
Yeah.
So life was easier before.
Oh, God. Decision paralysis. Next is stocks.
Okay. Stocks are really pretty straightforward. Take a company, you own a piece of that company, maybe 1%, 10%, the whole company. That's all a stock is ownership in a company. Normally they're publicly traded. And for this exercise, we're not going to talk about private companies. We're just going to talk publicly traded every day. And you own a share or multiple shares of a company. You could own a share of Amazon. You could own a share of Apple. What I like about them, you've got the potential that stock pays a dividend. So they may take a part of their profits and pay it out to you in the form of a cash payment as a dividend. And they typically pay those quarterly. Or that stock may go from $100 a share to $200 a share. That's a capital gain. So there's some really good growth potential in stocks, and they earn typically a much higher return than bonds. So what's the risk? You could have a negative return. Stocks often have a negative return. The stock market in general goes up 2/3 of the time, but it also means it goes down 1/3 of the time. And sometimes those drops are scary. So stocks are great. I'm not a big believer in individual stocks. I just think it's too much risk for the average investor. And if you think the stock market's volatile, owning an individual stock, that jumps up and down like a kangaroo, okay? And it's tough to stomach when it's doing that. When it goes from, you bought it at 30, it's now down to $15 a share. What do you want to do with it? Oh, it's up to $45 a share.
Yeah.
A mutual fund typically moves up or down, but not at the same speed.
Okay, well, that was a perfect segue into our mutual funds.
Okay.
So let's talk about a mutual fund.
A mutual fund is really simple. Let's start with a stock mutual fund, okay? What we're going to do is we're going to go and we're going to put 15 different companies into a basket. So you've got shares in each of those companies, and you're going to put it into a basket. That's called a mutual fund.
Yep.
A mutual fund could have 15 companies in it, could have 100, 500. One I happen to use has 13,000 different companies in it. So the basket can be as big as you want, and you can put anything in the basket. You can have railways, you can have all the big companies, Apple, Amazon, Microsoft, Facebook, or you could have little small companies, as long as they're all publicly traded.
Yep.
The next thing is balanced mutual funds. So that's where you're taking not just stocks, but you're adding in things like bonds, or maybe real estate, or maybe cash. Maybe you've got all 4 working in a balance inside of a mutual fund. They typically are a little more conservative, will earn a little lower in returns. But they're still great. It allows the average investor to own thousands of companies with just one purchase.
Yep.
Okay? Now, what's interesting about mutual funds, they provide great diversification, as we talked about. You don't need to figure out what to buy. They're buying it for you. Some of them are, and this is where it gets a little complex. Some people hire a manager to run the mutual fund, and they choose what goes in. Other ones are called index funds, and basically all the stocks are pre-selected for you. So that's pretty much the difference. We're going to talk about which ones do better. My belief, and it took me a long time to learn this, and this is probably, I'd say, one of my bigger golden nuggets.
Okay, drum roll.
Active management doesn't do very well over time. Money managers can't predict the future. Therefore, they can't do a good job on predicting which stocks to own. And over longer periods of time, 10 years, 85% of them, 90% of them underperform just buying the market itself. So that's disadvantage one, they underperform. So if I was to say, Georgia, you've got choice A and choice B. This one wins 85% of the time. This one wins 15% of the time. Which one are you going to put your money on?
85.
It's simple. You're putting the odds in your favor of a successful event. When I started in the industry, there wasn't a choice to just buy the market. It didn't exist, at least not in Canada. So we had to invest with active money managers. And I learned, for the most part, over 10 years, 15 years, most of them, almost all of them underperform. And it's a bit like an athlete. And eventually the athlete gets old and stops performing. Same thing happens with a lot of mutual funds. But we're not going to do a whole thing on mutual funds right now. Suffice it to say, I would prefer you go passive with your investments. That's what I did. I made that change 20 years ago and have not regretted it for 1 minute for my clients.
And so redefine passive versus active.
Active means someone is buying and selling, changing the stocks in the portfolio to try and get a better return because they think right now there's some turmoil in the Middle East. Right. People are firing missiles at each other. So people may think I'm going to invest in companies that make military weapons. But the problem is the market's smart. The market's already figured out. They knew the rumblings of a war. Those stocks went up long before you realized it. So it's back to you can't predict the future. You might get it right once. You're not going to get it right multiple times. So I wouldn't spend. And the other part is those active funds are more expensive than the index. So it costs more to try and outperform, and then they don't outperform, so you're really behind.
Yep.
Okay?
So the takeaway is you'd recommend opting for passive over active.
All day long.
All day long. Let's move on to ETFs.
Okay. Exchange traded funds. So mutual funds are a little different. They are priced at the end of the day. So at the end of the day, they determine of all the values of the companies in that basket, and they give it a price. So a mutual fund may have a price of $15 to start the day, and it may finish the day at $15.30. You can't trade a mutual fund during the day. An exchange traded fund trades like a stock. You could buy it in the morning and sell it in the afternoon. You can sell it at any point in time and buy it at any point in time. And they, with the technology, they're able to determine what the value is of it. So it's got better liquidity. It doesn't mean it's a better structure. Some people, it's the best structure. I happen to use mutual funds, even after all these years, because the structure that's used, I don't trade. So I don't need a structure that I can trade every day. So why do I want that? Okay, so ETF is a great way to invest, really low cost, the cheapest. They're on an apples to apples comparison, they're cheaper than mutual funds, or at least most mutual funds. So if you are paying less for your investment, what's the advantage to you?
If you are paying less for your investment, it's costing you less.
Absolutely. Some have fees less than 5 basis points, less than 0.5%, they're all less than 1%. Whereas some mutual funds are 2 to 3% a year. So you can buy an exchange traded fund for 5 basis points, which is 0.05%. So some huge advantages there. You can get diversification with one click, another advantage, and it's easy to sell, get in and out of. So some people trade ETFs, just like they trade stocks. In fact, there's actually more ETFs and mutual funds than there are stocks. That makes no sense, but that's where we are today. There's more baskets than eggs available for the baskets. The thing about mutual funds and exchange traded funds, there's no guarantee for a return. You can lose money. It's not likely to go to zero because you own a basket of companies, but it's going to fluctuate in value. Not as much as a stock, but a lot more than a bond. So mutual funds, ETFs are great investments.
Awesome.
What's the last one?
Real estate.
So real estate, it could be the house you live in, could be an investment property, could be a cottage, a farm, a piece of land, whatever it may be, a cabin in the woods, or it could be a publicly traded piece of real estate called a real estate investment trust, or a REIT, what we call a REIT. And that's similar to a mutual fund where they put a basket of real estate and they trade the basket. Real estate's a great investment, can provide rental income besides just your housing. So if you've got an investment property, it has the potential to go up in value over time. We've seen real estate in Southern Ontario boom over the last 20 years. It's been a slowdown right now, but it's been a great place to be almost my entire career, 30 years. You can borrow money to invest in real estate, so that can help your returns. It does require, if you own direct real estate, it does require maintenance and management. If you've got tenants, there's costs involved. We're going to do a whole podcast on investing in investment real estate, but I think it's a great investment. But I think you need a mix. I think you need some stocks, mutual funds or ETFs, and you need some investment real estate as well. For this generation, it's probably too early for investment real estate. Okay? That's my take. If you've got the resources, go ahead, do it.
Got it.
Advantages and disadvantages. Advantages is you build equity and potential higher returns, cash flow. It typically keeps up with inflation, so it's called a hedge against inflation. So if in a period of high inflation, typically housing keeps up with it, or real estate keeps up with it. And the pride of ownership. I own a cabin in the woods. I own a cottage. I own a farm or a piece of land. Disadvantages, it's expensive to buy. You got to put a down payment. There's fees involved. There's lawyers' fees. It's not easy. It's illiquid. If you wanted to get out of it, it's tough to sell, right? You've got a piece of real estate, and there's only so many people that might want to buy that real estate. And finally, you get property damage. If you own down in Florida, there was the hurricanes that came through, and they created a ton of damage, wiped out some homes completely. Now people can't even get insurance. And if they have no insurance and they can't even replace the home they lived in. There's risks involved in almost all types of investments. Georgia, summarize what we've learned today for our audience.
Yeah, you've just talked about the 6 most common types of investments. The 3 main things that people should be taking away are, number 1, cash/GICs and bonds are good for safety and provide low returns. Number 2, equities, stocks, real estate are good for growth and provide higher returns. And number 3, mutual funds and ETFs are good for diversification.
Okay, I think that's a great summary. What we're going to cover in the next podcast, we're going to talk about your risk profile and your risk capacity. How much growth or equities should in your portfolio?
Awesome. Thanks for tuning in to today's
Thank you.